Hi, this is Carol Peugeot, and this is Miss Carol's Refresher Course. My students always refer to me as Miss Carol, so you can go ahead and do that as well. This course was designed for my alumni to refresh some of the things that we learned in class. Now, this can be for business or medical billing and coding. I'm going to touch on both of those areas. But it's also for anybody else, because you do not have to be an alumni to benefit from this program. At this point, what we're doing is Introductory to Accounting, because that's the course we were in the middle of when I had to not be their teacher anymore. So I want to make sure that we can go from the beginning to the whole process. So this is going to be about a six-week seminar, that's a good thing to call it, where I'm going to go over the basics of accounting. You do not need a textbook. So if you are one of my alumni and you have your textbook, great. If you're not, you don't need it, because I'm going to include everything you need in the notes and in the exercises and the worksheets. So you won't need anything. So speaking of worksheets, down below in the comments area, there's going to be links to where you can get the worksheets. So at the end of this video, we're going to go over a couple exercises together, but not too much. I'm going to start you off with some easy stuff first. So today, let's go ahead and get started with Introductory to Accounting. This is actually our second lesson. We talked about I introduced accounting last week and went over some of the terms and concepts that you need to know, such as the three components of the accounting equation: assets, liabilities, and owner's equity. We're going to talk more about that today. So today's lesson 2, analyzing transactions with the accounting equation. What does that mean? We're going to talk about that. So here we go. What are we going to talk about today? Well, we're going to define the accounting elements. Again, assets, liabilities, owner's equities. We're going to construct the accounting equation and learn how to use it to make sure that we balance. That's going to be the main theme today. If you take anything away today, learn how to balance using the accounting equation. Analyzing balanced transactions, in other words, what is it? And then show the effect of the business transaction on the accounting equation. I don't know what that means, Miss Carol. That's okay. I'm going to tell you. So here we go. All right. So before the accounting process begins, the entity to be accounted for must be defined, or the entry. I said entity. It should say entry. In other words, what it is that you're entering into the system. What is it? A business entity, now we're talking about entity, is an individual, association, or organization that engages in economic activities and controls specific economic resources. So in other words, it's anything, whether it's a business or yourself personally, that needs to control your money, or numbers, money. 3 basic accounting elements. We talked about that. What are they? Assets, liabilities, and owner's equity. You're going to be dreaming those letters in your head, just like with Sesame Street, how they float in your head at night. Assets, liabilities, owner's equity. Okay, so the very first thing when we sit down to do an accounting process is we have to analyze what the transaction is. So it's just fancy way of saying, is it a sale? Is it a payment that you're making? Or did you buy something on account? Or did the owner invest money into the business? Or did they make a payment? All those things need to be considered. What is it? So each business transaction is analyzed to decide what information to record and where to record it. For example, purchases, sales, payments, receipts of cash are all business transactions. All right, so analyzing a business transaction. A business transaction is an economic event that has a direct impact on the business. So again, I get a phone call. This is Carol's Cupcakes, and I get a phone call from one of my clients who says, I need 100 cupcakes for the birthday party this week, and I will pay you cash. Okay? So when that person pays me that cash, that is a business transaction. And then I also sold the cupcakes. That's a business transaction. It's sale and then the receipt of cash. Two things happen there. This must be measurable in dollars, obviously, for accounting, because, dollars in America and pounds or euros. I guess Britain is now back to the pounds. I don't know. Anyway, I'm concerned with American dollars. An account is a separate record used to summarize changes in each asset, liability, and owner's equity of a business. So, this is the important thing to keep in mind. Each account belongs to one of those three things. It's either an asset, or it's a liability, or belongs in the owner's equity section. Okay? And we'll talk more about that. I'll demonstrate that to you. All right, so a business transaction, we have to ask three questions. There are three basic questions that must be answered when analyzing the effects of a business. What happened? A sale. What accounts were affected? We just talked about that, right? Cash and revenue. How is the accounting equation affected? And again, that's what we're going to talk about, and I'm going to demonstrate to you. All right, before we do that, we need to go in and explain what each of these are. Assets, liabilities, owner's equity. So let's talk about what an asset is. An asset are items that are owned by a business and will provide future benefits. Part of that is what's called accounts receivable. Accounts receivable, or we might abbreviate that as AR, represents the amount of money owed to the business. So the people out there owe me, my business. That's accounts receivable. By its customers as a result of making a sale. So let's say, for instance, the person is not going to pay me cash. They're going to buy these on account, the cupcakes. So that's now going to go into, instead of going into revenue, it's going to go into accounts receivable. Because think of it as accounts receivable as money, but you haven't quite received it yet. The reason why it's still considered an asset is that it's still a value that increases the value of the company. The banks would look at that as an asset. You could actually borrow money against your accounts receivable. Other types of assets are cash, that's the first one. But there's also property, merchandise, stock, equipment, and other types of supplies.
Stock, property?
Property. I think I said that first. Yeah, property. So if you own the land, that is part of your assets. Okay, next one, accounting element, is the liabilities. Liabilities represent something that is owed to another entity. So in other words, my business, let's say Carol's Cupcakes, owes money on some equipment that I purchased on account. That goes into my what's called accounts payable, which is a type of liability. Liabilities are debts and obligations of the business that can be paid with cash, goods, or services. So again, you could pay for liabilities with equipment or goods or merchandise, or with cash. It's most likely with cash. Or with services. That's called the barter system. The most common liabilities are, what I mentioned before, accounts payable. Accounts payable is money that is owed by the company to outside entities. So again, accounts payable is going to be your most common type of liability. And then finally, we have owner's equity. Owner's equity is a component that has several different parts to it. It's the amount by which the business assets exceed the business liabilities. The other terms for account owner's equity are net worth and or capital. You have assets and liabilities and owner's equity. And we're going to dive into owner's equity a little bit more a little bit later. All right, so let me show you some examples. I've created a business, and not quite yet. We're going to show you an example. So here's the accounting equation. Okay. Accounting equation is the relationship between the three basic accounting elements. It's very simple. Assets equals liabilities plus owner's equity. So again, let's take a look at that. Assets must equal liabilities plus owner's equity. So in this example, I have in my assets $60,000, $400. Okay? So $60,000, $400. I also have under liabilities $5,400. And then owner's equity has $55,000. So let's apply the equation here. Assets, which is $60,400, equals liability, $5,400, plus owner's equity, $55,000. Excuse me. The liability plus owner's equity equals $60,400. So does this balance? Yes. Assets, the total of assets must equal the total of liabilities plus owner's equity. Okay? Let's give it a try ourselves. In this case, we want to complete the equation. If the amount on the left side, assets, is $80,000, which equals liabilities plus owner's equity, how much would the owner's equity be? So we have assets equaling $80,000, and if you look over here under liabilities, liabilities equal $50,000. So if assets is $80,000, in order to balance, what must my owner's equity be?
$30,000.
$30,000. In order to balance with the equation, my owner's equity should be $30,000 because assets equals liabilities plus owner's equity. Liability $50,000 plus $30,000 equals $80,000. So correct. Very good. So another couple examples. I have created a business called Clifford's Delivery Express. You like the little yellow truck? It's cool. Delivery Express. Not the brown trucks. It is the yellow truck. Bright and cheerful. Okay, so we have transaction A. We're going to assume the following transaction occurred during the month of June of 2021. As of May, it hasn't happened yet, but let's pretend it did. The first month of operations of Clifford's Delivery Express. Clifford opened a bank account with a deposit of $4,000 for his business. So what he did is he took $4,000 out of his own money and he put it into the accounts for the business. Okay? So there's going to be two accounts that are affected. Since Clifford contributed the assets, the owner's equity increases because he added value to the company. So, two accounts are going to be affected. And again, in this accounting, it's called double entry. Always going to have two accounts affected with every transaction. Okay. We'll get to more of that on later when we get into the actual doing transactions. So, under cash, we have $4,000. That's cash is listed under what of the elements? Assets, liabilities, or owner's equity?
Assets.
Assets. So assets, our cash, is totaled $4,000. Under owner's equity, we have an account called Clifford's Delivery Express Capital. The capital account is also going to be increased. That's going to be increased by $4,000. So, if we do the transaction or do the accounting equation, assets equals liabilities plus owner's equity. Assets equals 4,000, liability 0, owner's equity 4,000. Do we balance? Yes, we balance. Okay, it's going to get a little bit more complicated than that later on, but I'm just trying to keep it simple so that you guys can understand what it is we're doing here and how this accounting equation needs to always stay in balance. All right, the next transaction. Clifford's Delivery bought a motor scooter, because he's going to do like little carrier services, for $2,200 on account. In other words, by credit. So, remember our cash, we still have our cash there. So under assets, we have, under cash, $4,000 plus, how much was the scooter? $2,200. So the scooter is equipment. So that follows under an asset. So under assets, we have two accounts. We have we have cash, and we have equipment. So what is, what is the total for assets? $6,200 or $6,200. 4,000 plus the 2,200. Okay? Liability. Now we bought this on account, so this falls under which account? Accounts payable, right? Which falls under liability. So under liability we have 2,200. Okay? Stay with me. Under owner's equity, remember he
4,000.
paid $4,000, so under capital we have 4,000. So let's now do the equation, see if we balanced. We have under assets 62,000 plus we have 62,000. Under liabilities we have 2,200. We have owner's equity 4,000. So 62. Did I say 62,000?
62,000.
I am sorry.
We're making too much money too soon. Hey, where'd you hide that money at?
I'm sorry. 6,200. 6,200. That's right. Make sure the teacher is correct. So 6,200 plus, 6,200 assets equals liabilities 2,200 plus owner's equity 4,000. So 2,200 plus 4,000 equals 6,200 or 6,200. So do they balance?
Yes.
Yes. So there you see we did two equations, and those two equations still balance. Okay, so what I'm listing here are some transactions that you can practice with. So what I want you to do is name the two accounts that are affected and see how they balance. So, for instance, invested $45,000 to a new business. Now, when I say invested $45,000, you're assuming that it's cash. Because cash isn't necessarily dollar bills. It's money that is in the account that is instantly available. So the owner invested $45,000 to a business. So what two accounts are affected? You have assets, which is cash, and is there any liabilities? No. What about owner's equity? Capital. Very good. So we have assets, 45,000, liability 0, owner's equity under capital, 45,000. So yes, it balances. Next, we bought a delivery truck on account. We bought the truck for $2,000. Okay. So now we have assets. Did our assets increase? Yes. How did they increase? We bought a truck.
We have equipment.
So now I have a $2,000 worth of equipment in a truck. And we will talk about in our much later courses, probably in the intermediate accounting, we do a depreciation and interest. We'll get into that. Right now, we're not going to even worry about that. I'm not going to worry the fact that you drive it off the lot, it decreases value. We're not going to worry about that.
Simple accounting. Simple accounting.
Straightforward. But we do get into that. So that is something that is taken into account in accounting. So, but right now we have assets, $2,000. We don't owe any money on it because yes, we do. Rewind.
Accounts
We have
payable.
$2,000. We do owe money on it. We owe $2,000, so that's in accounts payable. Do we have anything in the owner's equity?
Yes.
No. Well, yes, previously $45,000. But let's talk about this individual.
Okay.
Let's not, we're dealing with this individually.
Okay.
Right now, no. So in this transaction, all we have is $2,000 in equipment, $2,000 in accounts payable, and at this point, nothing in accounts receivable, or nothing in owner's equity. All right, next one. Customer purchased $1,500 worth of services, paid cash. What two accounts are affected?
The capital account, because it's
It's not capital, but it's
No.
under owner's equity, and it's called revenue.
okay.
When you make a sale or you sell services and they pay cash or accounts receivable, it is called revenue. Or another word for it could be income. So in this case, since they paid cash, we have a cash and we have we have owner's equity, which is revenue. They both get increased by $1,500. So you see how every transaction requires two accounts. Okay. Next one, paid for a new set of tires for $500. Cash. What two accounts get affected? Well, we have a set of tires, right? So that falls under probably equipment. You know, later on we'll get into the type of equipment, transportation equipment and processing equipment. Right now we're keeping it simple. KIS, keeping it simple. And then what else? We pay cash. So what else gets affected? We pay cash for a new set of tires. What two accounts get affected?
Well, we have equipment or whatever. That's
Right.
the tires.
What else? We paid cash.
So we paid money out. So that's
So in this case,
less money.
the only two accounts that get affected are cash and equipment. So it's like taking one asset and trading it for another.
Okay.
The other two accounts don't get affected at all. Liability or owner's equity. Because we don't owe the money and it didn't increase the value of the company at all.
It's still the same value. It's straight across.
Right, straight across. I took one asset and traded it for another. Okay? So we'll learn more about that as we get into doing T accounts next week. So stay tuned with me as we do a couple little exercises together. I'm going to go over these together. I'm going to show you on the accounting equation how to use it. I'm going to give you a preview to a T account and show you how it works with the accounting equation. So stay tuned. Okay, so here we are with the accounting equation. We're going to do some exercises. And this is the accounting equation worksheet that I have included in the comments. Now there's two of them, two versions. This one, what I did is I color-coded them. I color-coded them based on what type of account they are. So in this one, we have assets, which is like this yellowish thing, has cash, accounts receivable, supplies, and equipment. Under the green is our liabilities. We have accounts payable and payroll. And then owner's equity, we have capital, drawing, revenue, and expenses. Now, under this one, you could see cash. Anytime any of these are added, you would add, plus, addition. Any one of these, addition, you add it. Under capital, under owner's equity is where it gets a little confusing. We have capital, you would add, but drawing, you would subtract. Revenue, add, expenses, subtract. And I'll explain that. I'll explain it. Okay, but first let's do a simple one. The first one, we have assets, cash of $200. We have in our accounts receivable $400. We have our supplies $325, and our equipment $1,000. Under accounts payable, we have $125. Under payroll, 0. Always want to make sure you zero out your columns. You don't want to leave a column just blank. Under capital, I have $500. You see that's a 5. Drawing, 0. We're not going to do any of these right now. And revenue, we have $1,300. And then expenses, 0. So, what I have to do now is I have to make sure our accounting equation balances. Assets equals liabilities plus owner's equity. So let's add up our assets. So 200 plus 400 plus 325 plus 1,000 equals, and I'm just going to put it right here, 1,925. All right, so assets must equal liabilities plus owner's equity. So now I'm going to take, I don't have any subtraction here because they're all positive accounts, revenue and capital. So I'm going to take the accounts payable, 125, plus capital, 500, plus revenue, 1,300, equals. So these two together equals 1,925. So they balance. Okay? All right, I'm going to do one more. The first one here, we have cash. We have 7,300. Under accounts receivable, I have 0. Under supplies, 0. Under equipment, 0. Under my accounts payable, I have 650. Under payroll, I have 150. Now, under capital, 0. Drawing, 0. Revenue, 7,000. Oops, one more 0. And then under expenses, 500. Okay? So, I don't have to add up our assets because we know that 7,300 plus 000 equals, I'm going to put it up here, 7,300, right? All right, so now we have to add assets equals liabilities plus owner's equity, our liabilities plus our owner's equity. So 650 plus 150 equals 800. I'm going to put that right here. Circle it. 650 plus 150 is 800 plus 0 plus 7,000. Now, let's add up our owner's equity first before we add it to our liabilities. Okay? So, we have $7,000 in revenue, but we also have $500 in expenses. So we had to pay out for something. Maybe we had to pay a utility bill or something, $500. So instead of adding this $500, what am I going to do?
Subtract.
I'm going to subtract it. So that leaves me with what? I can do it on here, just those of you who can do it in your head. Minus 500 equals 6,500. All right, so now let's see if we balance. We have 7,300 equals 800 plus 6,500 equals 7,300. Do we balance? 7,300 assets equals liabilities 800 plus owner's equity 6,500 equals 7,300. Okay? So I have a couple exercises for you in the comment section. There's an exercise called the accounting equation exercises. Now, it's just like what we just did, except one component's going to be missing, where you will have to figure out what that component is. So, for instance, if I had $500, just like we did earlier, where if I had $50,000 in liabilities and I needed $80,000 in assets, how much does my owner's equity have to be? $30,000. So you'll have to figure out what component is missing and how much that is. So we will go over that as well together, and I will download, or I will have a copy of the key so you can check your answers next week. As promised, in a few minutes, I'm going to just briefly show you what a T account is and explain how we do the T accounts and how they relate to this particular equation. Okay, so this is a little preview of next week. We're going to start talking about T accounts. And once we start talking about T accounts, we're going to be using T accounts from then on. And what T accounts are ways of showing the accounting equation and making sure that it balances. So T account looks like this. Notice how we have assets, liabilities, owner's equity. And under owner's equity we have expenses and drawing, but we also have revenue and capital. Okay, so a T account looks like this. So here I have cash. Cash is going to be your most common, so I always make the T account really big on cash. Then I have equipment. Then I might have over here under accounts payable, maybe the truck I'm going to owe money on. And then under owner's equity we have capital, and revenue, and over here we might have utility bill, utility expense, And we gotta pay our electric bill, cell phone. Okay. So these are our T accounts. Now, on the T accounts, keep in mind that debit is always going to be on the left, credit is always going to be on the right. So I notice I have it here. Debit on the right, on the left, sorry, credit on the right. Debit left, credit right. Debit, credit, debit, credit. Now, whether it's an asset or liability or owner's equity, how they are increased differs. So under asset, it increases by debiting, decreasing by crediting. Under liability, it increases by crediting, decreases by debiting. Owner's equity, the same thing, increases by credit, decreases by debiting. Unless it's an expense or drawing, then it's the opposite. So think of them as mirrored. So somebody pays me cash, or let's say Carol's Cupcakes. I put in $5,000 in cash under my business. So what two accounts get affected? Well, I said 5,000, right? I added $5,000 cash. So how do I increase an asset? By debiting it. So I'm going to put it on the left side over here. And what other accounts? It's my capital, right? How do I increase the owner's equity? Credit it. $5,000. Okay. Again, if I was to add all these up now, at this point, my assets would equal $5,000. My liability, 0. My owner's equity, $5,000. Assets equals liabilities plus owner's equity, and it balances. So we're going to do a lot more than this, but I just wanted to give you this little preview what we're going to talk about next week, and we will be working on from there on. But in this week, I want to just get used to using the accounting equation exercise and get that in our mind, getting used to balancing. Okay, so we have come full circle now. So this is Miss Carol, and this is Miss Carol's refresher course. Still haven't come up with a fancier title, but hey, sometimes we got to stay with something simple, right? Miss Carol's refresher course. I hope to get a hold of my alumni, especially the business students who didn't get the full accounting course with me. I want to, again, start from the beginning and move forward. Today we talked about the accounting equations, assets equals liabilities plus owner's equity. And then next week we are going to do the T accounts, like I just got through showing you an example. We'll get much further into that next week. T accounts, debits and credits. And so this is Miss Carol from Miss Carol's refresher course, and I'll see you next time from Innovate Training. Bye-bye. Hi, this is Carol Peugeot, and don't forget to subscribe, to like, and to hit that bell because we got a lot of good stuff coming. All right, see you next time.